Unajua msee, tumia nani yo check?
Tumia balance yo check.
Hey.
Whoa, whoa, keep it going. Whoa,
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 whoa.
keep it going. Whoa, whoa, keep it going. Whoa, whoa, keep it going.
I only hang with the best, taking this fortune, I'm feeling blessed. You only hang with the weak, getting misfortune, call it distress. You say you keeping it neat, I don't wanna lie, you're making a mess.
They said that talking is cheap, I stay with my words and trying to say less. Just like, whoa, 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 keep it going. Whoa, whoa,
Whoa.
keep it going. Whoa, whoa, keep it going. Whoa, whoa, keep it going.
Kazi endelee.
Guys, we're keeping it going. Kama kawaida, we're back for another episode of the Your Mentor Money and You talk show. And as usual, I'm not alone. I am with my amazing guests. To my left, I am with the amazing Collins Rotich. Can I get a whoop whoop, please?
Whoop, whoop.
Yes. And to my right, I am also with my friend, young Papa Thomas Ongaro. Can I get a whoop whoop?
Whoop, whoop.
Guys, welcome back, man. How you feeling?
Asante sana.
Salama kabisa.
I see you guys are in some new jackets.
Yeah.
I don't know. I've noticed. I don't know if that's TDC.
That's TDC.
Is that TDC?
That's TDC.
Oh wow, that happens. I know the designer. I know the guy who made those jackets. He's my friend.
He's your friend?
Yeah.
He's very friendly.
He's a he knows finance actually. He does. He has a talk show apparently.
Who's that, you guys? Who are you talking
You don't know
about?
him.
Oh,
You don't
okay.
know. Maybe it's others who know him.
It's an inside joke.
Ladies and gentlemen, as I said, welcome back to the Your Mentor Money and You talk show. We're here for a very, very, very special episode. Not just because we're having another amazing topic, but mainly because this is episode number 20. You know what that means?
Episode 20.
Episode 20, guys. We have done this for 4-5 episodes.
4 5.
Yes, we have done it for 2 10s.
120.
120s. I mean,
10 twos.
bro.
4 5s, yeah? You said 4 5s?
Yeah, 4 5s.
Okay,
5
good.
fours.
4 5s. Huh?
5 fours.
5 4s.
You guys, it's money and youth. I see you're good with numbers. Eh? I mean, looking back at... I was watching episode 1 the other day, and there's a lot that... our hair was not the same. That's the first thing that I noticed.
Even facial hair.
Every facial hair.
Well, speak for yourselves.
You could see like our... He's short. He's short shorts.
For no reason.
For no good reason.
As in, I'm just sitting here
Hey.
unprovoked.
It's gonna be a fire topic. That's how you know.
Collateral damage.
I'm telling you.
And it's not debt.
It's not
Collateral damage.
But the topic actually includes debt. So that's how you know. I've foreshadowed it.
Fire.
Speaking of, guys, this episode is brought to you by True Denim Collection. If you do not know what TDC is, you see these amazing jackets that we're wearing. Guys, please show them the jackets, show them the badges. TDC.
Made in Kenya.
So, if you don't know what TDC is, if you're a fan of high-quality denim clothes, a bespoke process that includes you in the production of your piece, and investing made in Kenya fashion, then TDC is the fashion house for you. Place your order today through the website at www.truedenimcollection.com and any of our socials, and we'll be sure to have you sorted out. So, guys,
Whoop, whoop.
do you know what the topic of the day is?
Yeah.
I don't think. I like that. We start incorporating a hands rule in all our topics moving forward. So, guys, keeping up with the series we've been doing, which is Unlocking Financial Freedom, we are going to be looking at safe investing for creative entrepreneurs with bonds. Hey, so I'm sure you guys have had bonds everywhere.
Covalent bonding.
What is bond?
What is bond? Oh, that's deep.
You're saying the chemistry types of bonds. If we had any guys who work with chemicals here, they'd be so happy. But no, the one that we're talking about are bonds related with finance. I'm sure most people know bonds by different names. Some people know treasury bonds. Some people know corporate bonds. And some people make the mistake of thinking that it's one and the same. So our job here today is to demystify this topic that is bonds in the best way that we can. Remember, guys, we are also more or less in the learning process as much as you guys are. We aren't finance specialists or anything. Maybe Kolo, he has offshore accounts somewhere, he deals in dollars. He deals in Kiare, he deals in dollars, and he has offshore accounts. I'm not saying anything. So, as always,
Nothing in my name.
nothing in your name. Yeah, it's in his father's name apparently. So that's what I hear.
Wife's name, apparently.
That's true love, right
Yeah,
there.
you know? That's what Sonko's doing.
Yeah.
Yeah.
So, much like I've done with the previous series where we've looked at the different instruments, I'll do a bit of history into bonds. This time it won't be as heavy as I've done with the last episodes, because doing the research on this one, I noticed there's a lot of jargon that if we were to look into it, would be a 4-hour episode. To be
be a
honest.
class.
It would be a class.
Wasa at a bonda.
What? Okay, so
That was my last one.
This guy's on fire.
I'm done.
So, do you have it all out of your system?
No, I have-
Do you have many more for the episode?
Puns on puns. It's coming.
So, okay, let's start with more or less what is a bond. Let me start by simply describing the term, so that moving forward, whenever you hear us mentioning it, you have an idea of what we're talking about. So, basic description. Bonds are fundamental financial instruments, essentially representing a loan from an investor or to a borrower, which can be a government or a corporation. In exchange for this loan, the borrower promises to pay regular interest payments over a set period and return the original principal amount at maturity. If you've watched, let's say, roughly the last 4 episodes, you've heard, mostly Kolo, you've been mentioning a lot about, when you talk about securities and equities, bonds tend to be mentioned as an example somewhere there when you're talking about them. So if you've been following the series, you'll be very excited, because a lot of things you'll notice are actually coming together. Even as I was doing the history, I noticed a lot of things that we talked about in NSE. The history is linked to the bonds actually. So are you guys tucked in? Are you guys comfortable? I don't see comfortability. Yeah, nice. You see, that's all. So let's start with the global contextual history. The earliest known form of a bond dates back to approximately 2400 BC in Nippur, Mesopotamia, located in modern-day Iraq.
Before Christ.
You know what that means?
Yeah, before Christ, those bonds.
And Mesopotamia, that was like the earliest civilization, mind you. If I'm not wrong, that was the first civilization when they were using the agrarian revolution, more or less.
Oh, that's okay.
So this is like amongst the earliest forms of, I'd say, the different financial
I
instruments.
mean, it makes sense.
Sindio. Now you'll be surprised how they actually used it. This ancient instrument served as a surety bond, surety, Kiingereza ni ngumu, guys, I'm sorry. It was more or less guaranteeing the payment of grain by a principal and ensuring reimbursement if the payment was failed. So grain often served as the priced currency in these early transactions. So as you can see, it was more or less debt, but through the form of barter system in ilikuanga back.
Actually, barter trade is the most efficient form of trade.
Don't make us have a topic
you don't pay
barter
taxes
trade.
on that.
Youth barter trade episode.
Literally, you just exchange products. No taxes.
Collins.
Save money.
Kere, you see what I'm talking about. Many talks of not paying taxes. Okay, so this foundational example illustrates the core purpose of bonds, which is to formalize and guarantee debt obligations, providing a measure of security for the lender. So moving forward, the concept of state-backed debt through bonds gained significant traction in Europe. As always, if you've noticed, most of these finance instruments, they kind of get some form of legitimacy when they get established in these European markets. Same thing as here. So the Dutch Republic became the first state to finance its debt through bonds, assuming bonds issuing the city of Amsterdam in 1957. And these were more or less I'd say the first instance of corporate bonds, because they were traded through if you remember, we talked about it, the Dutch East India Company. Remember, we're talking about it. They were the first company to more or less trade shares when they were selling them off to people who were interested in buying.
Shout out Amsterdam.
Shout out to Amsterdam, guys. So, building on this precedent, the Bank of England issued the first official national government bond in 1694 to fund a war against the French, directly copying the Dutch approach.
Whoa.
It's actually funny. Between, I haven't put this in my notes, but when I was doing the research, I noticed. Between this time, 1694, and let's say some time past World War II, most of the bonds were directly linked to war.
It makes sense.
The American Revolution, that was amongst the first time when the US started working with bonds. There's another example that I saw, but just...
It makes sense.
Yeah.
I mean, the business of war, the war of business.
Exactly. And most of these, if you think about it, back in the day, war was both power, how it was structured, and how war was financed. It would make sense to finance through something like bonds. If you get what I mean. How long the campaigns were, you could, something like the 70-year war. Wow, we're going into so much history, guys. I mean, I'm such a huge fan of history. If we start, I will not stop. So, parallel to the rise of sovereign debt, modern corporate bonds began to emerge with the establishment of formal banking systems in the early 17th century Netherlands. The Dutch East India Company, in 1623, pioneered the widespread issuance of bonds and shares to the general public to finance its extensive global trading operations. From this point onwards, different states and corporate entities introduced various types of bonds. For example, mortgage-backed securities. This is now linked to 2008 financial crisis. We'll talk a bit about that when we're talking about the risks associated with this. So, I think we have some form of understanding of history, where it came from. Sindio? Let's now come to within the continent. Here, there's not a lot also, without going into a lot of details. Formal bond market activities in Africa saw significant early development in South Africa. Shout out to SA as always. The Bond Exchange of South Africa, or BESA for short, was granted its exchange license in 1996 and played a crucial role in developing the country's bond market, establishing itself as a leader among emerging market economies by 2008. This pioneering role by South Africa provided a blueprint for other African nations. Despite this, most sub-Saharan countries have had a limited experience with international sovereign bonds, with only 11 accessing these markets in the last decade. Examples, so you guys know, Ghana, Senegal, Zambia, Nigeria, Morocco, and Kenya. I don't know the rest. Now, let's come to our beautiful country, Kenya. Kenya's bond market traces its origins back to the early 1980s, when the government of Kenya first utilized treasury bonds as a means to finance government deficits. In these initial stages, government bond maturities were typically short-term. The first corporate bond in Kenya was issued on November 8, 1996 by the East African Development Bank, or EADB. Is this bank still there?
Probably a different name.
A lot of its history is shared with the Nairobi Stock Exchange. For example, in September 2006, the Nairobi Stock Exchange implemented automated trading system, or ATS. Remember I was telling you guys about this, how before they would do the... So this allowed for live trading of equities with capability for immobilized corporate and treasury bonds. More or less, through a system like this, there was now much more... It was much easier for Mwananchi to have access exactly to working with bonds.
Financial inclusion.
Exactly. So, as there's so much in this topic of bonds, all I can do is I can advise whoever is watching to go and do your history. I have really just touched the surface. I didn't want to eat a lot of the time. But here, a bit of notable achievement in Kenya's bond market. So you can at least understand how the bond market in Kenya has evolved over time. Number one is the Kenya Diaspora Bond was launched in 2011, which was aimed to fund infrastructure project back then. But according to my research, it had mixed results. Please don't come for me, whoever implemented that program. This is what I saw online. Number 2 is FTSE and SE Kenyan Shilling Government Bond Index, which was launched in October 2012. For most of you, those who don't know, indexes are more or less tools that are made to help track these different, say, markets. If you watch finance news, mainly linked with the US, you'll see something like NASDAQ, S&Q 500. That's more or less an index. So in Kenya, we have one for bonds called the FTSE NSE Kenyan Shilling Government Bond Index, which was launched in 2012 in October. This was the first of its kind in Eastern Africa, providing reliable performance indication. Finally, another notable achievement. We have a lot, but I only chose 3 in the sake of time. We have Green Bonds Program Kenya. I think you guys remember hearing something about green bonds, yeah? So these were launched and aimed at catalyzing the market for green bonds. More or less, when you think about carbon credits and such, this, I think, was a way of the government trying to make money from that whole fiasco. So what's going on in 2025, you might ask me, in the whole bond market in Kenya? So in a strategic move to manage debt maturity risk and lengthen its debt profile, the National Treasury announced in early 2025, which is this year, that it would cease issuing new 364-day T-bills. T-bills, for those of you who don't know, is just short for treasury bills. Investors will now primarily see 91-day and 182-day bills in auctions. This reform aims to reduce the frequent refinancing burden associated with 1 year of instruments and potentially channel more demand into longer-term bonds. This also will kind of link to the, I'd say, high-risk nature of bonds. For National Treasury to work towards changing something like a 364-year bill, it means there's a lot of defaulting. But as I said, we'll talk about this. So I hope you guys have some form of historical, contextual background for the topic that we have today. Sindio? Yeah. So, my brother Collins, how are you doing?
Salama.
My brother Collins Rotich. I have called you by your full names. How are you doing?
Niko salama, labda wewe.
Mi niko poa sana. I have said so much, so many things. It's even boring. I don't understand what I'm talking about.
It's technical.
It's very technical.
Technical. Bonds is like level 3.
For someone who looks at anything bonds related and imagines that there's that notion of this is just for rich people and bankers and financiers. I don't have money. I don't have 100,000 Kenya shillings. So bonds si yangu. For someone like that, how would you demystify bonds and explain it to them?
Okay, demystifying bonds for the layman.
Yes.
I think at its core, the easiest way to think about it, a bond is a loan, in short. The difference is that, of course, it has different names, it's a new term primarily, but primarily it's just basically a loan. Like what basically happens is that a government or a company decides to embark on a project and they don't have the money for it. So they need to get that money from public. Remember previously we were talking about for stocks, it's whereby you put your own money into a business. And when you go into now asking money from the public, they buy shares into your business. Now, the other way of raising money from the public, instead of them owning a percentage of it, is known as debt. And one debt instrument is now a bond. So basically, that's it. So Gava says, we want to build a road between maybe, like Express or something. This is an infrastructure bond per se. We want to expand our infrastructure as a country. So what do we do as government? We don't have the money. We need 30 billion. Where are we going to get this money? So what we do is we issue a bond. A bond is basically like buying an IOU letter, Kitam, if you think about it from that perspective. So the government says we need 30 billion from public. So guys, who can give us 30 billion? Of course, no one has that cash just like that. So you'll find that institutions and the public now bid to actually buy this IOU. You get. So that's where even the bond auction terms come in. But that's a bit, we'll go into that for now. But primarily, Gava says we need 30 billion. I'd tell us how much can you guys give us. So the minimum you can buy is lots of either 50k or 100k, depending on the type of bond. Let's just use 100k because that's like the most for most bonds. That's where you'll find the benchmark is. So what happens is that in 30 billion, how many 100ks are there? Utapata is like maybe 3,000 or 300, something like that. So what happens is that certain companies will come in, they say we'll give you 5B because that's a big corporation. You as an individual investor, I'll give you 100k. So guys put in all of this cash together in Africa 30 billion. Gava builds the road. You get. Gava gets revenue how? Through taxes. What Gava does in its taxes, that's when unasikianga story ya deficit na surplus. Kwa the taxes, it needs to pay back all of these loans it's borrowed. Remember, it borrows money from IMF, from now bonds as well. So it borrows money from different types of people. And when it collects taxes, it starts paying guys back. So now since they have your money, this 30 billion, and they're going to pay you back on it, they give you a small, it's like rent for your money. So they pay you in intervals. Gava pays in intervals of either 6 months, there's 3 months, depending on the bond. There's even, there's 3, 6, 9, 12.
So now this comes back to how those that your 364
For the 364-day T-bill, because there's 90-day T-bill. You get what it means is that you'll get back your money within 364 days, within a year. You get, so we rent your money for 1 year, and for that we pay you in certain intervals. So the most common bonds you'll see are the longer ones. Unapata Gava takes you 30 billion for 10 years, and then they pay you 10% of that 30 billion every 6 months, or maybe if it's 10% annually, they pay you 5% 6 months, and then the other 5% at the end of the 12 months per se. They pay you for that whole period. Then after they're done paying you after those 10 years, they give you back your money, the 30B. So if you gave Gava 100 rakh, you'll get back your 100 rakh after that period has ended. Hence the term maturity. When the bond matures, you get back your principal, the money that you put in. But in between that process, kuna hizo ma 6 months payments you get. It's a very, and then remember, Gava will always pay its debts. Okay, unless a situation like Ukraine happens, Gava will always pay its debts. That's why it's called a risk-free asset in finance to some degree. There's an element of risk, but it's only on like really dire situations that Gava can really default because they're legally obligated to pay you. The only reason Gava takes money is for government spending. And government spending, as per the legal nature of how governments work, needs to be paid back to whoever you borrowed the money from. So bonds are almost risk-free. So it's basically that. Give your money to Gava. Gava builds this road. Gava builds a school. Gava does projects that improve the country. And now that they've done these projects, they pay you after a certain period, hence 10 years. So you might even find that the government that pays you the cash is maybe the next Gava. It's a very long-term period. There's even bonds for like 30 years. So that's basically it. You're just loaning your money out to Gava or corporates, and then they pay you rent on your money, and you get back your money back after that specific period has passed.
Is there a relationship between corporate bonds and treasury bonds? Because you've really touched on treasury bonds, but do corporate bonds work the same way? Like companies need to do something. Like we need to buy sewing machines as TDC, so we issue a corporate bond. And also, who buys the bonds typically if like a corporate issues it?
Other corporates.
Okay.
Sorry. So, like, remember, one thing that I've kept on saying for the past 20 episodes is that finance is only two things. Like, you can break down finance into two things. Equity or debt. Then every asset falls into those two categories. Equity, as we mentioned in the last episode, is shares in the company. So that project that you're saying, we need to buy sewing machines, we can put in our own capital as a business. You get? Or we can borrow a loan from the bank. Maybe the bank is too expensive. We can borrow a loan from maybe a SACCO. Maybe the SACCO process is too long. We don't want default. When you get like my interest charges if you pay late and all of those things. And a business has different cycles. So we can opt to issue a bond to the public. And what this means is that the public can buy into this project, and then we pay them for the money they've given us. So for example, as the same scenario for Gava, we pay you If it's 10%, we'll pay you 5% every certain period. If we say it's every 3 months, 3 months, 6 months, 6 months, 9 months, 9 months, 1 year, whatever. So it's the same instrument, like I said, equity and debt. And a debt instrument, bonds is one of them. There's also things like commercial papers, but that's a different conversation. But primarily, debt, ni deni, in short.
Okay. So now that we have like a better understanding of what bonds are and generally bonds market are, Thomas, I'll pose this question to you. Why do they matter for young creatives? Are they relevant? To be honest, they're not cool. So just get into a circle. We've had a young person talking about bonds before when you're 88 years old. So why do bonds matter, or why should they matter for young creatives or freelancers or people starting off in business?
I think bonds are very important to us creatives because you can earn money while it's not working. It's another way of getting your income through having your savings get you more money.
Money working for you.
Or work for you. Typically, as Kolo said, you put bonds, they give you an interest after every 6 months. The interest that you get every 6 months, depending on the period of time, can go a long way into generating more money from you on the side of the pocket. It's not easy to start, as you said. You start off at 100,000, 50,000, which is not easy for creatives, considering our flow of income is also up and down. We don't get things straight at once. We don't get things at the end of the month, So for you to start investing in bonds, you'll have to really be aware of your financial background and how you can navigate it through working that 6 months period without cash. So for us, it'll the fact that it's bringing you side income is that's where I'd vouch for it at 100%. And the risk. The risk of bonds is not the same as circles or any other.
Can you expound on that? Because even my next question was more or less to compare bonds to these other instruments. And for me, when I look at bonds, the one thing that creates some form of barrier to entry is that there's like a huge chunk of cash that you have to put into, as opposed to, or rather compared to the other instruments that we've dealt with up to this point, be it SACCOs, be it MMF, be it stocks. All of them to some degree, if you have 1,000 bob, you can get into it. I don't know, or rather, if I want to get bonds and I have 1,000 bob, how can you help me? You get what I mean? So more or less, comparing bonds to these other more or less
Other
instruments,
investments.
how do you think they stack up? I'd like to get your take on it, because you have a very interesting way of getting to this tool through using this tool.
Okay. Maybe just to add on what Thomas was saying, for a young creative, considering your cash flow is very irregular. Like as we've done projects with corporates, unalipo after 90 days. So between now and 90 days, you're just chilling. So you'll find that different types of influencers get different types of payments, and sometimes they come in lump sum. So if you get a lump sum payment, it would make sense for you to have a bit of security on this cash. So if you put that, let's say you're given 300 rakh. If you put 100 rakh in a bond and you're sure every 6 months you're earning 10% on this, or even maybe 5, 6, 7, 8 or 20%, whatever the rate is, 18%, maybe you're earning 9% every 6 months. You're assured that my 100k, ikifika 6 months, kuna do fulani that's coming in. So it also kind of helps you escape that freelance mindset whereby I get paid per projects and it's not always that cash comes in. So for a young creative, it's a good way for that kind of security. Comparing it to other financial instruments and options, you'll see this a lot online, especially if you do research. They always tell you, put your money in MMFs until you reach a point whereby you can put it into other assets. You get. For me, it's a bit different. May I say put your money in a SACCO until you can borrow that money to put it in another asset. Nonetheless, so it depends on your specific strategy. So for me, I'd say if you're comparing them with other assets, let's look at it from a risk perspective. Bonds, it's called risk-free in finance to some degree. There's of course risk, worldly factors, but ceteris placibum, I don't remember the term here, all factors held constant, bonds is risk free. Or as in, as long as Gava doesn't fail, bonds is risk free. Meaning that in my list of like financial instrument, bond has the highest favorability for anyone who doesn't want to lose their money. Because the thing about investing, it's not something active unless you're a trader. It's something that you're doing passive. Basically, you're trying to put your money in all of these assets such that they can be able to pay for your expenses, such that you don't even need to work.
Can you explain you the factor of as long as Gava doesn't fail? So you can, whoever is watching can understand that correlation between the very low risk of the bond and the nature of the government itself.
Like the only way bonds can fail is if maybe a nation fails, and it becomes a point that now honestly you can't get money from Gava. Because think of it as any, like, let's say if I give you 10k chai, then you're doing your biasharas, you're making cash, you make 12k, unanipea tao moja, unabaki, you get like una interest with one you're making. What if chai you crash, you go bankrupt?
Ni cheesy.
You're not capable of working anymore. How will I get that money from you? So it's same thing as Gava or any entity. Don't just think of Gava as, because Gava is more or less the entity behind order. Like even if you do history, the only role for Gava is to give us governance, to give us order. So when there's disorder, saw your story. I'll give you an example. Like Traore, he said he's not paying loans ya kitambo or something. Yes. Your story meisha. Hizo ma loans. Oops. You get, so like if you reach a point whereby you get a leader that's like, you know what, sidai kufanya hii stuff. Na mtadu. Na for real mtadu. You get like, that's a very, very, very extreme example. Like in the past 300 years, there hasn't been any kind of that crisis. Even colonial days, there was a bit of stability. Even if a coup happens, Gava
still have to more or less maintain
law
projects
and order.
will still continue.
Kwanza law, it's legally bound also. So it's very, very, it's risk free. Tuseme, it not in your lifetime. Haitachomeka in your lifetime. it's
I like how you saw risk free was very not in your lifetime.
Unless maybe like an AI undertaking, and then the government is AI now, and like the president's like, yo, human deaths, nah, you guys. So that's like, so for me that's like number one is that's the least risky. So, and when you're investing, you also have to consider those kinds of things. Like remember, your investment is basically your vehicle to buy you your freedom. Because if your expenses are 100 rakh and you put in, you're cashing these assets for 10 years, and then they're giving you something like maybe 60k a year, it means that you keep on investing until you get that extra 40 rakh to wipe off your expenses. Meaning that even if you stop working today, your bills are always sorted. So bonds is a very good area to put your money, because infrastructure bonds are tax free. To make it, there's this other bonds, especially like treasury bonds. You find that they might have like 10% or 15% withholding tax. So if you're supposed to expect like 5k, unapata 4250 or something. You get, so that's number one. Second, in terms of less risky, is number two is MMF. And MMF, because it's a money market fund. Basically, you're putting your money in a market. Someone comes and buys, like how unauza samaki, unaenda unafungua meza uneka samaki, someone buys and then in it. So it's the same thing for money market. The money is put in the public, corporates come take a bit of that cash. Gava comes takes a bit of that cash. So money market funds buy government bonds as well. So even to answer your question, ndiko hata umoja unataka kuingia bonds, kawezi
Ingia tu MMF.
ingia MMF because they're buying bonds indirectly.
So you'll kind of directly have
So what MMFs do, they have like a pie chart, and then they divide it into maybe half. That's a balance fund. So they do 50% bonds and safe assets like commercial papers and other liquid assets, and then 50% wanafanya stocks. So it's 50% equity, 50% debt. So I told you finance is just those two things. There's nothing else. Then other safer MMFs break that pie into smaller. Maybe they make it a quarter. So 75% bonds and other safe assets, and then 25% now equities. So that's number two, less risky. Yeah, it's almost risk free. It depends on also the Gava failing or even the whole financial system failing. That's when MFs can go down. Under that now, number three is stocks. Number three is SACCOs. SACCOs is only risky if your management is tricky, because SACCOs are led by the members. They elect officials. It's like UN SONU. You elect the student leaders. So SACCOs are the same. The SACCO members elect the SACCO management. So if your management is corrupt, of which it happens, like the Cusco issue. I mean, you're used to seeing like 100K in your bank account, and now you're managing.
Shout out to Cusco.
You're managing 4 billion, just like that. And then it's because it's a SACCO, there's less laws in terms of how you're meant to be regulated. Of course, unaweza toa tu 1B uweke tu mahali. Mtu asinotice.
Ndarudisha kesho. Ndalipa.
So that's the only risk for SACCOs. The management can really mess you up. Get. Then the now number 4, which is the riskiest, is now stocks. Stocks is only risky because you're investing in business, and business is like this. You get. Safaricom had a bad year with the whole trying to ingia Ethiopia. It's been 3 years. Bado iko 18 bob.
Bado price haijachange.
Unaweza imagine ulibuy Safaricom 50 bob, you spent 5M. Now your 5M is 1.8M. Si kila siku unashuta. It's like yo. So that's the issue with stocks. It's high risk, high reward. So that's like the risk profile for that. And if a young creative is trying to get into these things, I'd advise them that the easiest thing to get into is MMF, because the barrier of entry is almost low. Like you just need an ID, basically. Once you're into that, you can save up to your 50K, and then you now actually start buying bonds. Or if you're like me and you like taking on risk, join a SACCO, eka 100 rack. Take a loan of 100 rack, put it into your bond.
Hey, viewer, don't be like Collins.
Take risk. Because the thing I like about SACCOs, they spread your risk over months. Previously, mobile loans, you take a loan today, it's due in 30 days. Umechukua 100K, iko due 100K next week, in 4 weeks. 4 weeks, bro. Tatoa pia 100K in 4 weeks. Yeah. But a SACCO will spread that into 24 months. So instead of me paying 100 rack in 4 weeks, I'm paying 5K. Then I just pay 5K for 20 months. Okay. And then your 4K junior, the 4 extra 4 months. So it's very manageable. So even if you put your cash in that bond and it's getting you, if your loan is 12%, because that's SACCO rates, 12 to 14%, and that bond is giving you 18%, you're effectively getting 3% margin on your money. You get. So you're still growing. In short, the first rule of investing is never lose cash. So your cash is actually paying for itself, because you've taken money from other people, which is a loan, and it's getting for you money and it's paying back the loan. It's so...
Okay.
Yeah.
Thomas, what about you? How do you think bonds more or less compare to the different instruments that we've talked about, and even the ones that we haven't talked about?
I'd say bonds are more favorable considering the fact of the risk. The risk is very less. Also, the fact that you talked about infrastructural bonds, which give you a tax-free. So that's a very good way of trying to make extra money without, if you don't like paying taxes,
you should avoid taxes at all costs.
You can do that, and
you should have a clear official for one of the future episodes, just to talk.
Another thing I heard about bonds is you could use bonds as collateral on loans. So that was new for me. You could actually have bonds and then get a loan.
Can you expound on that?
What I had, I'm not very clear on it, but is that if you have your bonds, there are some investing firms that you can give them your bond, because they work with that.
Yeah, so you know how like banks usually give loans for a cash flowing asset. So like if your business is generating cash flow, your transactions, you're maybe doing like maybe 100K, 200K, 10K per month in your business, you can take a loan because they know they'll get that cash back. That's why salaried people are very good for getting loans. So I think even for bonds, considering you have the certificate,
it's an asset.
Yeah. They know you're getting payments every 6 months and you need cash now. It's a way of also, you can use it as collateral.
Yeah. Okay. So that's another thing. And they're more stable, basically. They're more stable than, as Kolo said, than stocks and every other thing,
Actually, you said that, you reminded me of another thing. Sorry to interrupt. But like, there's this thing known as bond coupling. So like you because the bonds are issued almost every month. Like every month or every period. So what you do is you can take a bond that pays you in Jan, you take another and pays you in Feb, another takes you in March, April, like that for like the whole 12 months, such that you always know, me every month kuna payment I'm getting from bonds, and it makes your regular cash flow makes sense. So even for freelancers, if you're getting like 300 rack, you can spread it out along different payments to make sure your whole year you're getting cash flow. But yeah, over to you.
Yeah. So as in, that was also very interesting. And yeah, so basically that they are more stable. You're more guaranteed to have your money back after 6 months with an assured interest. That interest, but it's the interest that normally they pay you the interest. The
coupon rate.
The coupon rate is what they give you. So that's for a time where you don't have money and you're not receiving money. Because I don't think as SACCOs you have to get a loan. Sindio?
Yeah, SACCO's only way you get your money is you wait 1 year, they pay you dividends, or you take a loan against your cash.
So you see that. Bonds, you're assured after every 6 months you're getting. So you won't feel bad that you don't have your money because you've given out 3 million or 4 million. You won't feel bad because at the end of 6 months you're probably getting 320k, 400k back into your account. So it's a more safe bet, I'd say. It's a more wise bet. But at the beginning it's safe, but it's also it's up there. It's not like
you have to play. You have to get here and sit with us first of all.
If someone is like, I don't even have 1,000. You're telling me about 100 of these thousands.
I think this is the first instrument that we've come across where there is that sort of barrier to entry.
Yeah, there's a cap.
Kununua shares ya BAT na ABL.
For those who don't know, how much is BAT right currently? Per share.
I haven't really checked
It's
recently.
like 300 and last I checked was 360.
Yeah, it's around 360, and then ABL is like one like around 180. I mean, is it 118? Yeah, it's around 11 bob. It's around 11,000 to 18,000. It ranges around there. Kakuzi ranges around 40k to 50k to buy 100 shares.
Really,
100 shares.
To be honest, I'm seeing the issue with shares near the fluctuation. Like imagine I bought shares. If I bought British American Tobacco shares when they were at 400, because remember the first time I checked their price, it was 412, roughly there, and then the most recent I checked their price, it was 360. So I'm trying to imagine if I bought it when it was up at your 400, vis-a-vis comparing it with something like bonds, for example. I just know I'm putting exactly. I'm putting X amount of money, and at the very least that X amount of money it won't go to 0.5x. You get what I mean? It will still remain X.
Yeah, true.
That's kind of the one thing that I've kind of pinpointed with the risk-free I'd say
aspect of the bond
that we keep more or less.
Gava will always pay its debts.
But mind you, what about corporate bonds? Because even my next question is more or less looking at the risks and downside of investing in bonds. Because unlike governments, companies are rent assured. They tend to fail sometimes. What do you think about that?
Yes and no. I think the existence of regulatory bodies really stabilizes some of these other risks. Like, yes, it's risky to put your money in a circle, but there's a whole SASRA that is regulating that. For you to become a public company, there's a whole like list of requirements that you need to do. For you to become a bank, kuna like minimum cash reserves you to have. So, and that's why GABA is important, because of governance. So all of these different sectors have ways in which risk is mitigated due to the level of governance and regulatory compliance that exists. So even for corporate bonds, by the time a corporate is asking money for bonds, they've already met so many criteria, it's hard for it to crash. Like the only companies you kind of see crashing in the past 10 years ni tech bros. Because tech bros are getting money from venture capitalists, and that means they can just keep on siphoning cash, trying to sell it to the next. Then it's like tag, this investor put in 3M, you're trying to tag it to the next investor. So by the time that tag you it, Mushad dish investors like 140 M USD, and then they just write it off as an asset. So, but most of these industries are relatively stable. Like it takes a very crazy, either a very brilliant mind in the stealing of cash biashara, like a good con man. If you put a good con man as a CEO, mkosa, you give it time. Like there was this bank that failed. I've forgotten. There was a bank that failed some time back, and apparently they were falsifying records for like a good 10 years.
In Kenya?
in Kenya. Then the only time they got caught was when now that guy, the CEO, died. So now the board is like, satafaya nini? You know,
In Kenya, we have like uncharted stories of this time when financial people stole money.
In finance, there's a whole section written, why do banks fail? So like, if you study finance, that will be one of the things you learn. And most of the time, it's human error. It's never systemic errors. It's not,
Because systems run.
because
Once they're set up,
because a system is how components work together. So it's very hard. So yes, risk will always be there, but there's a whole, like, even a course or even degree for risk mitigation. And these are people who wameenda shule wampata first class, wamesomeshwa hizi vitu. By the time it fails, as in,
Basi shida iko wapi? My job is to ask you guys the questions. I'm asking what problems. It can't be a perfect tool. That's what I'm more or less trying to scrutinize.
it's not a perfect tool. You get, but as in, it's like, you know, like how in statistics unakuanga na 95% confidence level, meaning that there's a 5% margin of error, or like not margin, there's a 5% lack of confidence, significance level. What that means is that there's always outliers. You get, the same way there's short people and there's tall people and then there's average height. The same way kuna mse atapata 02, kuna mse mwingine atapata plus 98, na kila mse atapata 50 to 70. There's always those anomalies. But if systems work the way they work, it's, and Kenya is one of the, but they shout out to Kenya by them. Mkiangalia the rest of Africa,
Kumechapa. Wow,
bro,
wow.
systems, bro.
You know, funny enough, whenever I'm doing the research on like the history, and you look at within
Utapata SA,
Africa,
Kenya, Nigeria.
Exactly.
Lakini Nigeria pia inakuanga hivi.
Lakini Nigeria
Inakuanga hivi.
unajua.
Nigeria kitu nawasaidia ni wako wase wengi. Can you imagine an economy of like 300 million people? Is it
And
300 or
oil.
400? And oil. But also the numbers. Because if you think of business, you make money. Who has money? See, human beings. So if you have a market of 400 million, can you? That's why Safaricom wanted to go to Ethiopia. The market is so much larger than the Kenyan market. Because Safaricom, wakiuzia every Kenyan SIM card, 53 million people. How will they grow?
Okay,
You get?
They'll
Stagnate primarily. They can only maybe save costs on margins. But in the law of diminishing returns, after a certain point, even every extra unit you put into work is not growing. So to answer your question, it's almost risk-free. But you can have a 95% confidence level.
You know what? Let me ask Thomas.
No, he's right.
He's right.
Yeah. Actually, 95 is kind of low. Me, I'd say
96, 98.
So you're telling me this is why governments and corporates prefer it as one of their main, I'd say, instruments. Because one thing I also noticed when I was doing a lot of research is, for example, we were talking about the financial crisis of 2008. And if you watch a movie called The Big Short, I'll recommend it to... If you're watching this talk show,
You'd probably like it.
you'll probably love that movie. It talks about the 2008 housing crisis in the US and how it came to be. Without butchering a lot of data and just without misleading our viewers, most of these banks and financial institutions got a bunch of debt that were more or less linked with houses. And what these institutions did to more or less get the debt off of their hands is they piled it up with more debt and then gave it a shiny new name and then pushed it out to the next person to buy. So you see, you do that over... The system that was set up for this to happen was set up around in the 1980s. I think they're called mortgage-backed securities, if I'm not wrong.
Yeah, you're right.
So this whole system was set up in the 1980s, but it cracked in 2008. You see what I mean? When I was more or less trying to spot the limitations, I also noticed these things are like very solid. For you to find the limitations, you have to hack the system, essentially. You have to
topple the government.
State House is very nearby. I love my president. But essentially, you have to... the system has to fail. 2008 financial crisis, the banking sector, US kufa, it died essentially, and it affected the rest of the world. There was a ripple effect. So I think maybe that might be one of the limitations.
So maybe just to point as to why that system failed. Okay, watch the big. You said Big Shot.
Big Shot, yeah.
Okay, what's the Big Shot? What they were saying was they were selling. So in bonds, there's the same way kwa CRB kuna kuna so as I was saying, from the Big Shot, the same way kwa CRB there's different levels. So like for you, if you are risky to give you cash, they give you a very low rating. I think it's from A to I think J. So J are the guys who have the worst credit score. These are guys who are by if you give them money, there's a high chance you're gonna lose money. Then A rating is someone who you're like, umse tukimpea do atalipa. So guys who are salaried, by default unapatanga, they're usually in like my A to D. Alafu guys who are not yet salaried wako kampo, they start taking mshwari loans na wakose kulipa, unapata unaanza you're starting your life with a credit score of
Someone
J.
just shed a tear somewhere listening to this episode.
640 something, maze credit score of 600. Kwani
Could
are you a
just
criminal?
make someone somewhere listening to this episode cry because he was about to take that mshwari loan. Akaka chini.
Maze. So the same rating was there for government bonds. The reason why it failed was because you know what they're doing? They take a number of like the worst type of bonds, they group them together. But because you spread that risk, you can put it from D upeleke C. You get? Which that's how they were doing it. But see, there's no problem if it's just one or two bonds or something.
And all the banks are
Can you
doing
imagine
the
you do
same.
that for 10 years? So everyone knows, you have shit bonds. Good. I don't know if I can curse. But
Yes,
you
you
have
can. Yes, you can. If you have shit bonds, I
You have
will
shit
buy those
bonds.
shit bonds.
So if you have shit bonds, they will take 100 of them. So instead of a risk of like 50%, imeshuka to like 32%. So it gets a higher rating. So the issue there was even a culture issue. You get across the whole system, everyone was doing that. And I get so it's gonna crash. Like you get the only thing that ever makes systems fail is human beings. It's never the system.
Okay.
Yeah.
Tommy, do you have like any kind of risk or downside that you'd like to mention?
Lack of liquidity.
I mean, yeah, but that is actually a very, very big. To be honest, prior to us talking about this topic, I never cared or thought about. It was the unsexiest financial instrument that I could think of. I've said it, guys.
That's where the money is though.
And that's what you see what I mean. Like I've noticed, and the more we do these episodes, I notice with finance, it's just a matter of do I know and do I not know.
Financial literacy.
Financial literacy. That's why we're here, guys. So my last question for the day before we wrap up is, and this one I'll ask you, Tome, then I'll also ask you, Kolo. Can you take me through how to just buy my first bond in Kenya? I want to buy my first bond. What are the avenues for me getting there?
Okay, I'll give what I know from what I know. I've not yet attempted to buy my first bond, but
Thomas, you don't have bonds.
I don't have bonds. Unfortunately, I am not a forex trader. If I was a forex trader,
I didn't want to say anything. I didn't want to say anything about these
I'm
forex
not a
bros.
Forex guys, man.
Forex
We're
guys.
coming for you.
Don't buy a car.
We're coming
Buy
for
bonds.
you.
jenga inchi yenu.
Jenga nchi.
Jenga nchi.
So it's apparently back in the day it was harder to join in because you deal one with CBK. It was that's how you choose to be back in the days. That's why guys say ati bonds are for old people because you wouldn't find a young guy going to CBK.
Why am I going to CBK?
Me, first of all, I'm a Rasta. CBK has a lot of policemen. I've seen it from the outside. I have seen it from the
Hadi
outside.
ukitembea unaambia usitembea hapa.
Tembea pale.
Pale. Wewe.
Unataka nini
Unataka
hapa?
wewe. Are you going to the bank?
Hakuna withdrawals hapa.
Hakuna ATM. Enda huko.
You know, so that was back in the day. That's what probably even me I'd be scared back in the day to approach.
It's
The
intimidating.
central
Yeah, I feel intimidated.
bank of
Central
Yeah,
bank.
but even before I started buying shares, kuingia bank was very rare.
You ask yourself a lot of
You're
questions.
like, hey, what am I doing here?
like why is it
I
why
was
is it
supposed
hot
to-
outside and very cold inside here?
Exactly.
It's very different.
Yeah.
What about you? Is there like if I want to buy my first bond or if we've
Oh,
convinced
step by
a
step.
listener, yeah, like how can we make the process for them much more less mystifying? You get the whole idea of this whole topic was demystifying this thing that we believe is just for our parents and old people who aren't sexy like us.
So how do you make bonds sexy?
How do we make bonds sexy?
Right. Here's where we start. You first take off the hood to understand what's underneath. So let me take off the hood to understand what's underneath the engine, the car, what's in the engine. So a bond is basically this. As I mentioned, Gava says we want 30 billion. How much do you guys want? So they do something known as an auction. You know, you can't just buy a bond just like that. Before you even buy, you need to be accepted. So there's something known as bidding. So Gava says we want 30 billion. Wagwan, and you want to give that 30 billion at 13%. You know, so there's two ways you can buy a bond. You either bid competitively, or you just I've forgotten the term, but you just buy it at the rate they give you. You get non-competitive bid, a competitive bid. So non-competitive means that Gavag is saying we want 30B to now pay 13%. You said, "Sawa, may I want that? May I'll give you 100 rack for 13%." A big corporate that's giving in hundreds of millions that are saying, "Hey guys, check it, I'm giving you 200 million. Tebu muni pay 17%." So what happens is that they receive all of the bids. That's what actually over something. So what happens is that they want 30B, guys bid 990B. You get. So does Gava say, there's a lot of demand. So badala ya 13, tasema to balance it out. Wase wa non-competitive walikuwa wanataka 13, au wengine wanataka sijui 17. Let's just give them 13.7.
Okay.
You get. So now, and then after that, you get an email telling you that, now you can accept it. Now your bid has been accepted, deposit the money in your bank account. So now you put the money that you said, you 100 raki yako, uneka kwa bank, Gava inachukua, alafu unaanza kulipa. So that's the process from the Gava side. Now, how is it from your side? How does it look like? How do you start? Number one, for you to actually even pick up point you're bidding, you need to have something known as a CDS account. It's the same as for shares. Shares is CDSC account. It's basically like the price of a bond changes, the price of a share changes. So ukisema ati I have 100k worth of shares, it's not really 100k worth of shares. You have maybe 100 units worth 1,000 bob.
Okay.
Unaget.
Yeah.
So the 1,000 bob can change. But check where are you going to sell the 100 units? You need to have a special bank account known as a CDSC account for shares and CDS account for bonds. So step one, end of fungue CDS account. You can open one through either a broker or when there's CBK. And I recommend everyone go to CBK, enda tu kai chini kwa reception, wambie cheki, "Madam, nataka kubuy infrastructure bond." Rada. I'm assuming it's madam.
The guy over there with a beard on the other side just looking at you like...
You know? So atakwambia, okay, fine. Fill this form. So you just need a bank account because you need somewhere that they can get funds from. You need your KRA PIN and, of course, your ID. Usha apply. Now you can start buying bonds. Now the question is, where are bonds sold? You can buy bonds now, but where aren't they sold? So for shares, you buy them from the Nairobi Securities Exchange. Or rather, you go there to log in, you see the prices of shares. You go to your stockbroker or your bank, unasema, "Give me 100 shares of Safaricom at 18 bob." So for bonds, it's similar. On the website of Central Bank of Kenya, cbk.go.ke if I'm not wrong, if you go to the website, there's a section purely for bonds. They show you all of the bonds available, all of the ones which have been issued, all of the ones which have been bid, all of the bids that have been won, per se. So you go to the ones which have just been listed. Unaenda una click. Utaona hapo very fancy numbers. Do ISBN 11. Those are just basically the reference numbers. But if you open any of those PDFs, it will show you everything. Inasema, Government Infrastructure Bond 001 2025 April. We need 90 billion shillings. You get. We are giving 13%. You get. We are looking for this amount of nini. So place your bid in today. It tells you the opening date for the bid, closing date for the bid. And then now you just apply directly. So you're saying, "I want to buy this for how much? 100 rack." After the period, if you're accepted, you get an email being told, "Hey, bro, umekubalika, eka 100 rack in your bank account." And just like that, you start buying shares. So it's the website. The other way is through that they downloaded and they created an app for this. Inaitwa CSD actually.
Yes,
I know it's the opposite of CDS. CSD. Download the app on your Android device. Log in. They'll ask for a photo of your ID, create your account. You can see from the app and follow up on your investments. So, and then Gava releases, I think, weekly newsletters to show you what bonds are available. So unaweza angalia tu on their website ama on the app itself, you see what's available. You see if this is something you can be able to purchase. But step 1, enda central bank, fungua account ya CDS. Step number 2, enda central bank website ama the app, look at the available options. Step number 3, bid with the cash that you have. Very simple.
Yo, I would not have said it any better. That is how we're gonna wrap up our episode for today. You know what you gotta do. Go and get yourself some bonds. Salimia umadam kwa hiyo meza. Ataka kona ndevu kaa mimi. Niambie madam
Nimetumwa na Money and Youth.
Nimetuma Money and Youth nikuje ni buy bonds. Ataelewa ni nini.
Atajua kiontaka.
Bas. Before I wrap up, do you guys have any parting shots that you'd like to share with our viewers? Sorry, Tommy.
Yeah, what I'd say is I wrote something for you guys. Treasury bonds in Kenya, a smart way for young creatives to build financial stability. They offer peace of mind, steady returns, and a long-term growth. But like investments, they come with trade-offs. Start small, and aim for a balanced portfolio. Your art can flourish even more when your finances are in check and they are distributed and they're diversified, basically. Yeah.
Damn, this guy was there. Wow. Kolo, you have to match that now.
I think for me, and this is something that we've talked about from the start, he's talked about the diversification. Put your money in different pockets, get different returns, and then get an overall return. So for me, if you're starting off, I'll always say this, SACCO, MMF. MMF because you can withdraw the money instantly. SACCO because you can build up to getting credit. Because no one's going to give you a credit limit for 100 racks, especially if you're taking Mshwari loans. Kwanza, hustler fund, they have this new thing known as bridge loan. Unapata unaonyeshwa hapo, hey, I can borrow how much? 600 shillings.
Tena kwambia.
So now, if you want to borrow 100 rack, it's easier to just save it pole, even if you're doing like a G a week, a G like that for like a 2-year period, then you borrow against that. So in short, we've talked about bonds, shares, MMFs, and SACCOs so far. That is a very good portfolio in a Kenyan mindset. If you have that in your portfolio, maybe you have like 30% of your cash in bonds, 20%. If you're a young guy, I can save and go even 40% on stocks. Because if you do stocks vizuri, you can really grow your cash in 10 years. Like for real, like you can 4 times your net worth overnight by mistake if you take the right moves on stocks. Bonds, you'll just maybe double it in like 7 years. It's a long time. Money market is for short-term and emergency savings. Like if you have a car and you have an issue and you need 30K urgently, if you have that 30K in money market, instantly, SACCO, you need credit. You know, debt is what the rich use to get ahead. Because they don't use own money. When I talk about OPM, other people's money. Instead of me spending my money to buy that matatu, let me take a bank loan. Bank loan ni kosa kulipa, chukua matatu. I have no risk. So loan is very important. So those are the 4 instruments. 2 of them are debt, SACCO na bonds. 2 of them are good for investment. Medium is MMF, but then stocks is for growth. And that's a very balanced portfolio in a Kenyan perspective.
I guess mine is to say thank you for tuning in. Thank you for being with us for 20 episodes. Guys,
Episode
can
20.
I get a whoop, 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 whoop? Can I get a whoop, 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 whoop? Guys, we've been here for 20 episodes, man. This is dope. It's always better with every episode. We get to explore much deeper, much, I'd say, diverse topics, but it's very fun because I get to do it with the homies. We get to more or less, I don't want to say the same joke over and over, make these unsexy things very sexy again, if it makes sense. So also to say thank you to you guys. Doing 20 episodes, it feels like we've done only 5, to be honest. But I don't know. It's a blessing to get here. So keep up the good work to both of you, please. Please, next time when we have another episode, buy your bonds so we can flex on whoever is watching the episode.
100K.
100K. Tome has bonds. Don't listen to him as what he's saying right now. He just doesn't want to flex on you guys. Also want to say thank you to Second to None, the amazing studio where we've been filming our episodes at.
But that was a frequently asked question, by the way.
Guys, the studio is called Second to None.
Lava Latte.
Make your way to Lava Latte. Spiderweb Studios. It's at Lava Latte, State House. If you just want to feel presidential, if you want to feel pristine, make your way to Spiderweb Studios and you get the amazing hospitality that we have received. I believe that the Money and Youth talk show will become what it's meant to be at home, which is here. So thank you to you guys as well. You have done an amazing job. And I guess we'll see you guys in the next one.